Hello and welcome to Trading Growth and Value Stocks. My name is James Boyd. We welcome you here on this date of March 12th. FYI, we have a birthday boy, and there's the bell. And the birthday that we have tomorrow on March 13th is Jeff T. And so we'd like to welcome an early birthday to him. So everyone, just kind of welcome a happy birthday. So you gotta celebrate those birthdays for sure. So now also you might be wondering about the red shirt. So I have the green shirt probably 5 feet away. I always have it there just for a good omen. Second, I decided to wear the red shirt today because just like if we were in Spain and we were trying to get the bull to charge, what color do you wear? You wear a red shirt to see if that bull will charge. That's what we're going to be finding out today. So don't think about red as bearish. Think about, will those bulls charge? Okay. Now, also remember when we talk about this, in terms of trading growth and value stocks, we're going to be doing it from a stock perspective. And we'll talk about that. Now, some of the comments might be based upon an index, a sector, whatever, but mainly we're going to be focusing on stocks. Now, also remember that that does not mean that someone might not consider a derivative, but this class won't focus on that. Okay. Now, also remember the information here is provided for general informational purposes only. Also, remember when we talk about examples, they are just that. We will be using the Paper Money software application. Also, when we talk about investing, investing involves risk, including loss of principal, which is kind of important to understand is that the investor is taking risk. Without risk, what upside return do you have? Okay. So now sometimes the market can be more risky than not per se based upon volatility. There's some times where maybe the investor might say, look, I see more opportunities or see less. That's okay. Okay. It's like other things in life, like real estate, like business, and so on. Now, today, what I want to really do is focus on, we'll take a quick look at markets briefly. I want to talk about kind of also where precious metals are, which is, I think, kind of interesting. And second, I want to talk about some stocks that might be bearish in the shorter term, intermediate, and longer term. Normally in this class, we talk about bullish examples almost thoroughly, but I do think there's a couple pockets of a couple of industry groups we want to keep an eye on and kind of also be looking for some bearish fundamentals as well. Let's take a quick look at some areas. Those areas that I want to talk about are really retail stocks, housing stocks, and I also want to bring up one other area, precious metal stocks, which is going to surprise you when I show you that. And then we'll finish off with some bullish examples. So let's go ahead here and take a quick look. Now, first off, when we look at the the SPX, what you're now going to notice is we've been talking about the stochastics really for, almost 2 weeks. And if I look at this stochastics and what we've been talking about is, can we get the stochastics to come out of that oversold area? And the answer is, with today's action, not yet. Okay? So we're still in the oversold area. No change. Kind of surprising, but it has. Now, what does that really tell us? Bears are still in control. The other confirmation of that is when we look up at the moving averages just to verify, do we see any color change on the moving averages? Not yet. So what are indicators really designed to do? Well, just like a stop sign or a traffic sign, they're really kind of meant to tell us kind of the timing. If we have red, it actually means that, hey, don't go per se. And if we have green, hey, probably could see a setup, okay? But what you're going to notice now is we still kind of see this downward slide on the SPX. Now, the other thing is we want to look at candles. Now, always remember when we see trends that are down, we see this phenomenon where we tend to go up for less than 3 days and fall back down. We went up for one, fell back down. Up for one, fell back down. Up for one, fell back down. But remember, if you use the candle type like Heikin-Ashi, it's going to smooth that out. And this is going to surprise you a little bit, Heikin-Ashi. You're going to notice that if we look at a Heikin-Ashi, which looks at a different formula to get to draw the candle, you're going to see that if you look at Heikin-Ashi, there has been no, or there shouldn't have been, any confusion on the SPX. Bears in control. Now, buying the stock is not the same as maybe other trades that maybe you might be thinking about. But if we're talking about buying the stock of the S&P or something that tracks the S&P 500, man, that has been on fire, okay? So if we kind of said that, are we at that bottom yet? We would have to say, like, if we're at the bottom, tell me where you see that. Okay. So, I mean, at least as of, here we are, March 12th, 4:04 Eastern. If this is the bottom, it's red. Okay, now let's go back to just real quick the VIX. Only comment I really want to say here on the VIX, we said yesterday, I'll say again, just a reminder. Remember, when we get, first off, when we get an uptrend, which we don't necessarily want an uptrend on the VIX, but we had it. And if we look at this upward trend, we kind of have this nice run to the upside on the VIX if you were maybe bearish. And what you're now going to notice is we saw the price today, or the VIX level, close below the diagonal line. So what you're going to notice is when we went up, we've pulled back down, right? Went up, kind of flagged, right? Ran up, pulled back. Well, this was the opposite of what the SPX did. When we went down, a red candle fired right back to the upside, meaning volatility didn't drop for very long before they came back in and bought it again, okay? Today is the first time that we've actually seen some volatility fall. Now remember, being short volatility, you could say in some senses like being bullish the market, okay, to a degree. So this, if we kind of said, what is the canary in the coal mine? We would actually say volatility dropping back down. We said if it gets down below the 25, bullish investors might like that as far as the first early signs of any buying at all or short covering. Now, what I think is very interesting is when we look at, let's say, gold, and I want to kind of consider, let's say, precious metals as a sector. Okay, this is going to kind of lead into our discussion. So we know that there's consumer staples, okay, where, you know, Kellogg's, Heinz, whole nine yards. But let's kind of think about, let's say, precious metals, looking at the prices of precious metals as a sector. Well, if we looked at gold, this has been the first time we've really seen two moving averages go green on gold. I said yesterday a comment that when you look at, let's say, what's happening with copper, it's very unusual if things are horrible out there economically. That should not normally be hitting brand new highs. If copper's hitting some brand new highs, usually the economy's doing okay. It might feel bad on the portfolio, but overall, you see copper still hitting a brand new high, poking the key word above the ascending triangle resistance area. The other area that we got a little push on is in terms of the level, and I need to show you these because we're going to come to the stocks in just a moment. When you also look at the silver price, what you're now going to notice is that did also hit a short-term high. So I want you to kind of think about precious metals as a sector. That if we kind of said, hey, there's three stocks that represent the sector, such as gold, silver, and copper, kind of what would that sector be doing, okay? So kind of think of this as another area where investors might try to go. Last thing I want to kind of bring up when we look at the sectors literally, when we take a look at this, I want to kind of show you something. When we look at kind of the weekly return, some of the areas worse than others, of course. You got discretionaries, financials, real estate down 3%. Interesting. No, not down 30, down 3. You're going to see that also staples in the last day or two. I want to know your comments on that. Was down 3% for the week. Okay. Flat for the month. Healthcare down 2.5%, down 1.4% for the month, down 1% for the utilities, down 1.78% for the month. So when the markets are really going down, even those areas like utilities, healthcare, V for healthcare, U for utilities, R for staples, and I'm going to do RE for real estate, even though when the market is actually dropping down, the harder it actually drops down, even the pockets that have, let's say, less potential risk, perhaps, utilities, healthcare, staples, real estate, they can even get caught up in the sell-off. Now, they didn't sell off at the same percentage, okay? And most of this run, they held up pretty good until perhaps the very end. Now, if Jeff T's birthday is right, March 13th, go look at my X page. I retweeted, okay, something about seasonality in the markets over the last 20 years. If Jeff's birthday is really that good, and I hope it is, seasonality-wise, March 20th over the last 20 years tends to be the area of that potential bottom, okay? Now, also, so what I want to do is I want to kind of just go back to any questions we have so much, okay? Now, comment is, I'm loving the trend types. They're making so much sense to me. Well, let's kind of bring this up for just a moment. So number one is, again, we're sticking to the same things. You don't need to recreate something every week, okay? I mean, what's wrong with what you're looking at? Got to ask that question. Now, if we take a look at, let's say, the trend, okay? And this is also kind of another way in which we kind of look at the trend in terms of, let's say, trend 1 through 5. Just briefly before we look at some stock examples, remember, if we're in a situation, okay, and I've had some questions on this, so let me just address this. This chart, I've been using a 10-day exponential moving average. I've been teaching off that for 22 years, okay? A 10-day exponential moving average, and that red line right there is a 30-day simple moving average. Now, back 22 years ago, never even heard of a whole moving average, okay? And different kind of formulations of different technical indicators, they change over time. Whole moving average being one of them. Well, why do you use the 10? Okay, well, we use the 10 because we're trying to get something that gives us a gauge of momentum, but also something that could be potential support or resistance. I have played around with maybe like using a 5, using a 7, using an 8, using a 9. The 10 kind of tends to seem to be that nice sweet spot, if you will. Feel free to practice, kind of check yourself. But we don't want something so tight because we want to act like a potential support or resistance, depending upon if we're playing bullish or bearish. The 30-day simple moving average might be a little long, but that's kind of the point, is you're trying to see what the intermediate trend is, not short-term trend. That's the exponential moving average, the blue line. The red line is just giving us basic trend. So when we say 30 days, we're talking about 30 calendar days, and so that's really about 6 weeks. And when we talk about intermediate, we're talking about something weeks to months. So it's fulfilling the purpose. Now remember, on this, if we get the red color candles, what is it telling us to do? Or what is it maybe kind of showing us at that point in time what the trend is? Well, if we get red color candles, it's actually saying sellers in control, and you're not getting any buy setups yet. Now, the other question that was brought up by another Jeff, geez, so many good Jeffs out there, okay, was the question, well, what is a bearish exit? Well, a bearish exit could be a bullish entry. I repeat that. Go back. A bearish exit could be a bullish entry. But what's a bullish entry? A bullish entry could be like the price breaking above the diagonal line or the shorter term line. A bullish exit could really be a bearish entry. So it's kind of interesting how you go from one to the other. And it really goes down to the common denominator is, are you blasted trading above the 10-day moving average for a bullish position, or are you trading down below a 10-day moving average for a potential bearish position and or exit? Okay? So remember, when you get the price below that short-term moving average, the 10-day exponential, what's the prediction? Prediction? Pain. Okay? You remember that? Yeah, I know you did. Okay? I was going to cut my hair kind of right down the middle. Leave a little patch down the middle, I should say. Pain. Okay, but that's really what's happened. Is, you know, when markets go up, geez, they can go up a lot if we're above the 10, and if it's down below the 10, my gosh, it can seem like it's like goes down forever. Welcome to momentum. Okay. Now, also, so I just want to answer that question on that. Now let's kind of talk about something that I think is kind of interesting. Okay. So first off, I showed you gold, I showed you silver, I showed you copper. Okay. Try to give you an idea of where those stocks have really been. I should say the prices. Now let's look at the stocks. Okay. Now you would expect that if the prices of gold were that high, and if you would expect that, let's say, if you looked and saw where copper was and silver, that maybe some of those companies that are in that space might be doing pretty well. Well, let's go check. Well, so first off, if you take a look at FCX, here's a company, this is probably the most known, not the only one, as we'll see in just a sec. But what you're now going to notice is when you look at FCX, it's really been in a downtrend. So if I overlay the chart, click on that little test tube there, or I could do it this way. Let's go to where we go studies, okay? Let's go add study, and we'll just do compare with. Now this will automatically give me something like a gold and silver and index itself, but I'm gonna put a custom symbol, okay? So the candle chart is FCX. And the custom symbol, we're just going to put gold price. Well, as you expect, the purple, okay, is the gold price. And you look at FCX, it's inverse. Now, that's really awkward because you would expect that, gee, shouldn't they be going up somewhat together? Well, that's kind of like the question, okay? Why is it not going up? What is happening with this company where it's just struggling, okay? Now, I want to kind of talk about some bearish fundamentals. Now, when we take a look at this, you might be thinking, well, why are we going to talk about bearish fundamentals? Well, because not everything goes up all the time, and we want to be educated on, like, hey, if you wanted to trade bearish or considered it, kind of what are some companies that might be struggling fundamentally? So if you say, James, I'm a bullish investor only, what do I get out of this? Well, then you get out of this of maybe some warnings or some red flags and maybe some companies potentially not to consider. If someone else says, James, I'm bullish and bearish, I want to look at bullish trends, fine. But I also want to look at, kind of have some education on which are some companies that might be fundamentally struggling, but technically as well. I want to see both sides of the coin. So I have some opportunities on both sides. Now, what I want to do is I'm going to go to analyze real quick and go to fundamentals. Now, what I'm going to do is when we take a look at this, you're going to see that if someone asks you a question, like what would you be looking for to kind of say the company might be struggling fundamentally? Okay? What would, if someone asked you that question, what would you tell them? Well, I think if we kind of went back to sales, okay, sales is a way to kind of start, like sales per share. What you're going to notice is the sales per share have actually been the highest, which is not surprising because what they've been selling is the highest, okay, that it's been. Sales is not looking at cost, though. It's not looking at cost. Sales, another word for revenue. So that's not going to catch it in this case. So if I went down to the bottom and actually said, hey, what do we got in terms of, let's say, the earnings? The earnings has kind of sunk a little bit. 21 was higher. 22 was a lot higher. Half as much as it was from 23 to 22. And another almost half as much as we were from, or less than half, of in 24 compared to, let's say, 21. So even though the price has gone up, it has not gone down to the bottom in terms of net income. That net income divided the net income divided by the number of shares to get earnings per share. Now, if you look at the dividend, the company, even though it's not making a ton, they're giving, okay? If we look in 23, they're giving half of their earnings per share in the form of a dividend. Now, I want you to imagine yourself that at the end of the year, you saved $10,000. But then Kevin said, hey, you owe me $5,000. And now you only have $5,000 left. So when you don't have as much money in savings or earnings per share, it's hard to grow. Now, if Kevin said, you're a really nice person, you don't owe me $5,000, you can keep the $1.28, you can keep 100% of what you have to try to save and or invest. Now, what you're now going to notice is this company in the last, let's say, 2 years, they have been giving half of their money away in the form of dividend to investors. So that could be a kind of a little concern of something that the dividend, if we had something where the earnings per share dropped, you get a bigger and bigger percentage of the pie earnings per share going to dividends, which might hurt the company in terms of the numbers. Now, I just want to kind of speak to this just real quick. When we look at ROE, it's okay, 15. Pretty decent number, actually. When you also look at gross profit margin right here, 17. Not the highest, still decent. When we look at operating profit margin, 36. And when you look at net profit margin, all the way down to 7. Now, I'm going to show you some different companies here. Now, obviously, we're probably the most interested with net profit margin because if things go to hell in a handbasket, per se, that net profit margin, you need that to kind of have some profitability and some breathing room. So I want to kind of also look at just another company, just briefly show some differences here, AEM. Now, AEM has kind of done something a little bit different. It's gained in 23 and also gained also in there 24, okay? You're going to also see that it doesn't pay 50%, but it's close in terms of the dividend. So AEM kind of being a little bit better, and also in terms of profitability. And then also if we kind of went back and said, is there any other stock that might kind of be in that space. Let's go GOLD, Barrick. Now, if you look at Barrick in 21, 114, down to 24 cents. Ouch. Now, notice something, doing this one on purpose. Their dividend was 40 cents, and their earnings per share was only 24 cents. Where'd they get the money? Okay. They borrowed money, perhaps. They took money from savings. This is where Kevin, hypothetically, took the dividend, 40 cents, and the person said, but I only have 24 cents. And that person said, stinks for you. You promised you would pay the dividend unless you cut them. Now, the next year they came back, and now there's a little bit more breathing room. Now, Kevin's a great guy. Let's change the name here, okay? But so I want to kind of show you that. When you don't have a lot of earnings per share and the company pays a dividend, that's a problem, okay? Now, when we also go down and look at the bottom here, the net profit margin on this company as well compared to the first one we looked at is stronger, okay? So I want us to kind of watch kind of some of these companies. When you look at gold and let's look at AEM, they've been a little bit stronger. If you look at the company that really actually that was kind of going in line more with earnings, I'm saying, with earnings, it was AEM. So when we look at the gold price, there's more of a relationship to the technicals and also the fundamentals. If I went back to the charts and I went back to, let's say, studies, add study, and say, I want to kind of see how the price of gold /GC, and we're just kind of using that. Think of that like an index. If the index price, so to say, is going up, or the spot price is actually going up, futures price as well, depending upon the month. If you look at that, the candle chart is AEM. And so if you take a look at that, you're seeing more in line. Does that make sense? So if you're kind of looking, let me kind of just show you this, just to backtrack for just a second, then we're going to look at a bullish bearish example. Let me show you FCX. See how that's like inverse? Okay. And then if we went back to, let's say, gold, doesn't correlate as well, but the one that kind of correlates the most with where we're actually seeing gold going up in price, and then what you're seeing in the terms of a company and the fundamentals, it's AEM. Okay. Now here's the thing. This is a stock. This can diverge away from the price of gold itself. Sure. As we saw in the other examples. Our first bullish example that we're going to do, but we're going to do a bear example too. So stay tuned. How do we take this off now that since I have this on? We're going to right click on that line, just right click. And we're going to say remove that study, the comparison. Okay. Now what I'm going to do is I'm going to right click on this chart and we're going to go down to buy custom with OCO bracket. Now, if we take a look at this, what I'm going to do in this case is I'm going to go back and act like, hey, our capital size right around $6,500. Okay. If I go back and do $6,500, it's going to give us 64 shares. So if I know that now, I just could type in 64 shares. Okay. Now, when we look at this, what we're going to see is from a technical standpoint, you're going to see that this kind of looks like a continuation pattern. Now, we're thinking if gold actually goes up, could maybe AEM, which has shown a history, could that also go up as well? And could those fundamentals support, okay, the technical price itself? And are people playing that correlation? Okay. Now, if we take a look at this, kind of the support area, if I were to ask you the question, where do you see the support? Where do you got it? Yeah, so if we take a look at this, what you're now going to notice is the support area that we can see right about 95.90. Okay, so about 95.90, but right about there, 95.90, less 2%. And what we got in this case is if I do less 2%, 95.90, less 2%, it's going to give us 93.98. Now, I'm going to go down and put that right here, okay? Now, I need you to kind of understand something. When someone does a stock position, why are they buying the stock? Why are they buying any stocks in general? Well, they're trying to get a higher return than just putting the money in a savings account, okay? They're picking stock, which is an asset class that's more volatile. So you got to understand that if you pick assets that actually are more volatile, Sometimes it doesn't always go up in your favor. Sometimes it goes down. Welcome to volatility. Welcome to the asset class that has more volatility. So we want the gains, but what if the gains attaches a string that says sometimes we can be wrong and we got to be willing to risk? Now, if the investor says, I don't want to risk, well, they got to kind of consider what they want to do. And the continuation, if I looked at this and said, is there a potential profit or price target? We go back and look at this and say, that's what we kind of see right there. I don't see any like resistance. The only thing I really see is a bull fleeg, okay, for the Canadians. Love Canadians. I lived upstate New York, okay? Now, if I take a look at this, and what you're now going to notice is I'm going to kind of go from where the resistance is down to that low. Now, if I kind of looked and said, where might that 161 extension be? That's going to be right in the vicinity of 114.82. Now, exactly? Nah. I'm going to put it at like 113 and a quarter. Shed 1% off, 113 and a half, etc. Our lines might be a little off, okay? I'm a man. I know I'm sometimes wrong. I just got to account for it. I mean, that's the whole thing. Now, what I'm going to do is go dated GTC. So I got a target price and I got a stop. So the first thing I want you to kind of think about is when we look at these examples is correlation. The longer you invest, you're probably going to be pretty interested in looking at stocks that track an index, stocks that track a sector, stock that tracks an industry group, stock that tracks a price, so to say, of like what we've talked about. I think a lot of times people just kind of put that underneath the rug, but I think it kind of deserves to be revisited. Now, on the comment regarding FCX, they must have cost problems. Yeah, you would probably say that if they're able to, for example, number one, they might, for example, might not be finding as much in terms of gold or selling. But we would kind of push back on that and say maybe it's doubtful because when you go back and look at that number on FCX, the sales per share was still quite high. So we would kind of push back on it that they're not finding anything because they are selling something. And they're selling something that has a higher value, and that is at the high. But maybe they're kind of trailing some of the examples like the AM example in terms of the number of ounces they're finding. The comment in the chat was regarding cost controls, okay? Clearly what they're making is not, or bringing in, is not dropping down to the bottom in terms of net income. So I concur with what you're saying there, okay? Now, by the way, if you ever said, where can I actually go to find information that they share with investors? If you go to pretty much any company's website, on the bottom of the website, top of the website, somewhere, bottom or top, it will have a link that says Investor Relations. On that link, Investor Relations, you're going to see that there's PowerPoints that they'll typically give more information about kind of some of those detailed type of questions. It's always kind of nice to look to kind of see what's going on, and they share that with the public, okay? Now, I want to kind of show something. So what we're going to go ahead and do is we're going to send that order. Now, remember, with a stop, we have to remember something here that when you talk about a stop, it's a trigger to sell. It's not saying exactly where it's going to sell for, okay? Quick reminder there. Now, I want to kind of go back to just real quick a company, and I want to kind of just speak to just real quick a bearish example for just a moment. Now, we know that there's been discussion on Walmart. We know there's been discussion on Costco. We know there's been discussion on Target or Target. I mean, where's the low on that? And we're also going to see Kroger if you live in the South, Ohio, whatever. Now, if we take a look at this, I just want to kind of go back to a stock, let's say Target, okay, just for a moment, okay? But I also want to include here Dollar General and Dollar Tree. But maybe it's not a Dollar Tree. Maybe it's a penny tree, okay? We're going to find out. Now, if we take a look at Target, this has not participated to the upside like Walmart and Costco. I don't think anyone would argue that. Now, what I want to do is I want to kind of show you three companies to show a little variation here. I'm going to go to Analyze and then Fundamentals. Now, when you look at this, when we look at the earnings per share, they are actually where they were about 5 years ago. Now, if you told an investor, well, we're exactly where we were 5 years ago, isn't that exciting? Many people don't think that's that exciting, okay? Now, the other thing to kind of understand, back when we were in 2020, they had a dividend of 268 and they were at 864 in earnings per share. So they maybe had about 30% of that earnings in the form of a dividend paid out to the shareholders. Now, the problem is you have a dividend of 444 and you have, let's say, earnings per share of 886. So when you look at that in terms of percentage-wise, 50% of the earnings is in the form of a dividend. Now, if those earnings were to drop, if you were to have, I'm hypothetically saying this, if you were to have a recession and the earnings declined, the sales declined, the earnings declined, well, that might mean unless they cut the dividend or trim it, you just have a higher percentage of the earnings going right out that back door to those shareholders. Now, the stock investors love it, but the maybe the higher ups don't thoroughly enjoy that because where are they going to get the growth from? Now, the other thing I want to kind of make mention of, you're going to see that when we look at these numbers, current ratio, okay? Think about current ratio as your cash, marketable securities, okay, your accounts receivable, and inventory. Anything that you could convert to cash within usually less than 1 year. On the bottom of that ratio, current liabilities, your accrued expenses, any short-term debt, okay? If we start to see these numbers less than 1, and this isn't horrible, but it's trending down that way, it's showing that liquidity is starting to be a little bit more of a concern. If we said, what is a good current ratio, we'd say anything greater than 2. Quick ratio. So when we say quick ratio, the only difference between current ratio and quick ratio is quick ratio does not include inventory because you might not be able to sell it at maybe the price you actually thought, which no pun intended, Target thought they could, and they couldn't. And so quick ratio is kind of being a little bit more doubtful that maybe that inventory could be sold as quickly to give liquidity. The problem with actually Target is that ratio is bleeding and bleeding, went up a little bit and bleeding. Now, if you talk to anyone that's ever gone broke, okay, maybe went personally bankrupt, they would tell you that their cash, the checking account went lower and lower, so did their savings account. They didn't have any money in their margin account, maybe their brokerage account, any cash, anything like that. It dried out. And then they just started getting more and more liabilities. Eventually, they just couldn't even manage the liabilities anymore, and they went broke. Okay? Well, the companies are the same exact way. My gosh, that was horrible. It was like, now I want to kind of explain something, okay? When we look at, let's say, a stock trade, okay? And I'm talking about up here, okay? I'm talking about up here. We have to understand that not every company is going to make it. Not every company is going to do as well. Some companies might just not be as attractive to investors, but also consumers, okay? I want to explain something to you for just a moment. Not saying that you have to do it, but I just want to have a foundational understanding, okay? So I want us to imagine that, for example, if you take a look at this, if we click on the ask price, we're going to buy the shares of the stock. That's what we normally do. Okay, fine. But if we clicked on the bid price right here, you're now going to notice it's going to create a sell order, okay? Now, I want you to imagine, let's imagine Bob, he goes to a bank. Bob puts in $100 to the bank, okay? Bob goes in, says, okay, I'm going to put $100 in the bank. Bob's maybe even expecting that he's maybe also going to get some interest, all right? Now, someone else walks into the bank, let's say Sarah, okay? Sarah walks into the bank and says, hey, I need to borrow $100. Now, wait, just real quick. How does Sarah borrow the money? She has to pay it back eventually. And then Sarah is also responsible to pay the interest. So Bob doesn't know that that money was lent to Sarah. And Sarah doesn't know Bob. Now, stocks are kind of similar in this analogy, okay? And there's some differences. So if I went to the bid price, if it says ETB easy to borrow, That means that, hey, some shares could be available to borrow. So when we say we're going to go long, we're thinking the price is going to go up and it's going to appreciate. Well, if the investor sells the stock, they sell the stock, the key word is in a margin account where you can do that or consider it. The investor could say stock sell minus 100. Now, what's the risk to this trade? Does anybody know what the risk of this trade is? Well, the risk of this trade is when you sell a stock, the risk is it has infinite potential loss. Number two, you might have to pay it back. You might have to get the shares back sooner than you wanted to. Number two, which I already made mention of, if that company does pay a dividend, Bob, remember I kind of said, Bob, someone's expecting the dividend. Who pays the dividend? The person that's short. Remember Sarah in the example? Sarah was paying the interest to somebody who was long, okay? So now I want to kind of do this as an example. Now, I am not saying that someone has to do this in real life. I'm not saying that. But there needs to be some foundational understanding of just if the stock were going to go down, could the investor practice a short stock position? So why are we learning a short stock example? Well, that way, if you wanted to go down the path and said, I want to learn how to trade trends that are bearish, where I'm seeing technicals go down, fundamentals erode, and so on, the goal is, does the investor know a strategy to do that? Learning about shorting is a foundational concept to go to the next step. It's foundational. Doesn't mean they have to do it in real money, but they should at least understand what it is, how it works, and what the risk is. So what I'm going to do here in just this quick example, I'm going to right click on the bid price. And what we're going to do is sell custom, and we're going to go with OCO bracket. Now, if we sell something first, where does the investor think the stock's going to go? Well, if you sell it, you actually think the price is going to decline, okay? Now, if you actually think the price is going to decline, this line, the first row that's in green right here, this is where the investor says, hey, James, look, I actually think the price is going to go down, but go down to where? Well, let's say the investor says, James, I actually think Target could be underneath some pressure here, and it could go down even lower, let's say $100. So what the investor's trying to do is to make from 107.35 down to 100. It's about $7.35. No different if they thought they'd buy the stock at 107 and it's going to go to 115. They're trying to make that difference. The thing is, it's just the direction. Are we long or short? Now, I want you to do this in the margin paper money account. You need to understand, so if you were to ever consider maybe derivatives of stock, that you have a foundational understanding of how it works with stocks. Not that you have to do it, but you could at least explain it and understand and say, I've practiced a few. We're going to go dated GTC, and the stop in a bearish stock position is it's not below us. That's if we're bullish, like we did on the previous example. We'd be doing, in this case, a bearish example. Now, I've been through the markets of 2000. I've been through the markets of 07, 08, 09. There's people that went through the same markets, but they don't do bearish positions. That's fine. It's up to them. Everyone's different. But I think if there are some stocks that are going down, it would at least be nice to say, I at least understand the idea of a strategy that I could pick and how it works. And I've practiced it before the stocks actually go down. Now, if I did 100 shares, I don't have to do 100 shares. Let's say I said I only want 50, okay? If I only want 50 shares and I say, where's the stop? The stop is just going to be above where we think resistance is. Now, I'm answering this because Jeff had the question on this, okay? Jeff had the question the other day, which is, where does an investor exit? Let's say the fundamentals improved. The technicals improved. Where can the investor say, I'm going to exit? Well, we know that the red color moving averages might be where the investor says, hey, I'm going to go bearish. Well, because we expect more selling than buying. But where might the investor say, hey, the trend is changing? When the moving averages change. So the investor might manually be watching this or setting a stop above a resistance area. So if I drew resistance and said, where do we think resistance is? We're going to take 115, 89, 83, and set a stop above there by, let's say, 2 to 3%. Now, guys and gals, I'm going to tell you right now, and you've seen a really good example in the last 30 days. When the markets go down, as an educator, I think I would do you a disservice to not help you understand both sides. Bullish, bearish. Okay? I kind of think of this like tennis. Bullish, forehand. Bearish, backhand. And if you said, I don't have a backhand, me, if I was playing you in tennis, I'd just keep hitting your backhand, okay? And try to expose you and frustrate you and make you quit and throw in the towel and say, I don't want to play you anymore. Well, that's kind of what bears do. And I said that last week when I went kind of crazy in the middle. But I was saying that's what they do. Because people eventually throw in the towel that they can't handle the downtrend anymore, and they just sell. And they tend to sell at the worst possible time. Were there sell signals along the way before they emotionally got to that point? You better daggone believe it. Why didn't they sell? Well, because they loved the stock. Technical analysis ain't love. It's not about loving the stock. It's about trading the indicators. Okay? Now, we go back to what I'm going to do is where's that number here? And that number was 118.46. Now, what's the risk on this? This is a stop. Does that guarantee an exact sell at that price or an exact buy, I should say in this case? Nope. I would like us to practice the bearish trade on Target, okay, Dollar General and Dollar Tree, and if we did one more, SNA. Those are examples, not recommendations. My purpose of going over a bearish example as well as bullish is I want to make you more comfortable on both sides of trend. By understanding also bearish strategies, it also helps you be better or tend to be better on bullish exit because you see both sides of the coin. That was my goal. Now, I'm out of my time here today. We did a bullish example on AM, okay? That was our bullish example. And then we also talked about correlation there and also companies that actually have technical trends that are matching the fundamentals. And then we also talk about some companies that, man, under pressure, fundamentally, technically, liquidity, okay, it's leading to some ugly charts with earnings coming up. Now, I'm out of my time here today, but it's been my absolute pleasure. I would tell you this, okay, it's not just about the charts. It's about money. And does the company actually have an increasing amount of money or not? That increasing amount of money or decreasing amount of money will then come back to valuation, and that valuation then affects potentially trends. So we want to kind of look at some of the things we talked about here today and see how these things play out. Remember, with what we discussed, it was done for example illustrative purposes only. And also remember, when we talk about these examples, that all investing involves risk, okay? And with that said, this has been the class on trading growth and value stocks. Thank you, Connie, and thanks to all of you. And with that said, have a great afternoon. We'll see you back tomorrow morning. Take care. Bye-bye.